Hey, this is Anthony from Op Fund Operation Financial Freedom. I read an interesting article that I want to share with you, and it's about the temptation of not investing in your TSP or your 401k or your Roth or your traditional IRA when the market downturns. So I want to go ahead and read this with you. And happy 4th of July weekend, which is upcoming, to all you active duty and veterans out there. So let me go through this and I'll wrap it up at the end. I'll get you an end result. So case number one, March 2000 to October of 2002, there was a 33% decline in the market. So if an investor was investing $500 per month in March 2000 and kept doing that even through the downturn and the turmoil, they would, as of March 31st of 2025, they would have about 700,000. Contrary to the wait and see, meaning the people that would pause or wait when we had a market downturn, saying, you know what, I'm going to stop the 500 a month and just see what happens over the course of the year and not put the dollars in, they would have 573,000 on the same day. So 700,000 to 573. Case number two, and some of you are old enough to remember some of these dates, October of 2007 to February of 2009. That was the 08 real estate crisis, Lehman Brothers, etc. Same kind of scenario, looking at a substantial downturn in the market, and the same $500 invested would reap about 360,000 versus 307,000. So if someone started later, why the numbers are different? Because we're saying that you started in 07 versus the first one was 2000. So don't get caught up in the numbers, but this is what's occurring. So $500 a month from 2007 to current, just steady on through, would have brought in 360, versus if you wait and wanted to see what happened to the market during that time, you would have 307. So this is substantial money that's adding up. But we're going to get through this and we're going to get to it. Case number three, February and March of 2020. So this is the COVID, and we have a little more of the COVID here, but this is the COVID downturn, which I vividly remember. I was loading up during that time. Every stock was like on a sale rack. It was great. It's like going out and finding, your best gear or the Garmin that you love, and it's just yeah, and it's all on sale for like 30% off. So February to March 2020, February and March of 2020, we had a 34% drop in value from February 19th of 2020. So the middle of that's when we had about a 34% drop. And then we had a 28.7% gain during 2021. As a result, the keep buying investor, so staying steady with $500 a month, all the way through, came out ahead. This article doesn't put the numbers, but it said ahead by March of 2025, even after suffering through market downturns in 2022 and early of this year, 2025, still ahead. So you can see there's a trend here. December of 2022 to October of 2022. The market reversal was a sharp reaction to 2021 unexpected spike in inflation, followed by a series of aggressive interest rate hikes. So this is current. U.S. market index lost about 19% from January through October of that year. So if you kept buying through, the investor would have ended about $7,000 ahead of wait and see by March of 2025. And the last but not least, case number 5, January 2000 to March 2025, so just a few months ago. And let me pause here. I'm going to put this stuff in the notes so you can go ahead and just read some of the data. So I want to put this in there. All right, so case number 5, January 2000 to March of 2025. The differences are even more dramatic over the long periods. This is 25 years. The analysis was $500 per month in January 2000, paused during each of the 4 downturns, which I just mentioned over the course of that time, and then resumed contributions after the market had bottomed out. And you really don't know that because the timing of the market, we don't know. If we did, everyone would be wealthy, right? So extremely wealthy. But even in this seemingly ideal scenario, consistent contributions won out. So even during investing $500 all the way through, pausing when the market started to go down 10, 15, 20, 30%. And then just starting. The market hit the bottom, established a base, and you're like, you know what? I'm going to get back in. Consistently, meaning you just keep investing. You don't look at when it's a bottom, when it's a top, when it's down. How I look at it is when it's down, it's on a sale rack. As Buffett says, what's his famous quote? Be greedy when others are... I'm not even going to know. What is it? Anyway, I'll find out and I'll do a video on that. It's something like be greedy when others aren't. And yeah, all right. It's too early and I'm 50. So anyway, the consistent 401 contributions ended nearly $200,000 ahead of the stop and start investor. The reason consistent contributions meant there are more dollars around to benefit when the market rebounded, while hitting pause on contributions meant the opposite. And the impact compounds over time. The wait and see investor would have skipped out on 61 months worth of contributions for a total of $30,000. Think about it. That $30,000 would have given you almost $200,000. Contributions of over $30,000, but ended with a balance of about $184,000, lower than the keep buying approach. So the moral of this story is your retirement, your TSP, your Roth IRAs, your traditional IRAs, your 401ks, wherever you are in life here as a veteran or active duty, don't time the market. Just dollar cost average, meaning just keep buying. If you're doing $50 a month, $50 every 2 weeks, every paycheck, when it hits, whatever you're doing, just consistently do it. Don't time the market. And remember, time in the market and consistent investing over time is more valuable than timing the market. All righty. Thank you. Like, subscribe, share, and I'll put some of this stuff in the notes. I know I went over it fast, but this stuff is the real deal, and consistent investing wins out every time. Have a blessed and good 4th of July. Stay safe and enjoy. Bye.